Hi and welcome to Swissquote's daily market talk. It's Thursday, March 27th, and the markets are hammered again by tariff fears. So here we dive again. Yesterday was a pretty ugly trading session across US and European equity markets, and Asian markets had a moody session today as well. The US technology stocks were particularly hit yesterday without a new and a surprise catalyser. Investors simply continued to step out of the markets on tariff worries, and later today Donald Trump announced that he would impose 25% tariffs on the US auto imports. Both finished cars and auto parts are going to be concerned. So GM, which was having quite a good rebound since the beginning of the month, actually tanked more than 3% yesterday. Ford managed to weather the news better than its counterpart, but closed flat yesterday's trading session, while Tesla, which is both a technology company and a car maker, died more than 5.5% yesterday. As such, the S&P 500 lost 1% and returned below its 200-day moving average after a strong fight to break the back of this resistance earlier this week, but in vain, while Nasdaq 100 index tanked 1.83% yesterday. Now note that the liquidity in the equity space is also draining right now, with Bloomberg warning that the most active contracts on the S&P 500 have the lowest liquidity levels in 2 years right now. So the lack of liquidity, combined with the lack of a strong appetite and the bearish sentiment, decreases the predictability, increases volatility, and also increases the chances of a deeper downside correction in stocks in the US and elsewhere. Because at this point, I think it is important to note that the bearish sentiment across the US equities is gently expanding toward the European equity markets. The massive government spending plans on infrastructure and security from the European governments being already priced in, the European equity investors are now facing the ugly truth of the hectic tariff policies from the White House, and the latter is also weighing on the Stoxx 600 index. It has just started weighing on the Stoxx 600 index recently. So the index lost less than its American peers yesterday, but lost 0.70% still on Wednesday, and that was also on the back of the growing tensions into the April 2nd tariff deadline. I personally believe that focusing on April 2nd doesn't really make sense. There will be a lot of April 2nds this year and the next few years, so adopting portfolios is a better idea in my opinion. In this context, the S&P's low volatility index that we've been talking about since a couple of weeks now is performing relatively well this year. It's not going to return the kind of gains or returns that we see in technology stocks, for example, but it will likely weather the market news and the hectic market moves due to these tariff news better than the more sensitive pockets of the market, like the technology stocks, for example. In the bond space, the US 2-year yield is slightly lower today, but the 10-year yield continues to push higher. The aggressive tariff talk from the White House obviously boosts inflation expectations for the US and hits growth expectations, and the comfort that the Federal Reserve could actually provide to investors and to the market last week by saying that a tariff-led inflation uptick would be transitory is losing its optimistic power among investors. Gold, on the other hand, remains the most reliable hedge against the Trump tariffs. The price of an ounce is set to climb toward the uncharted territories into the April 2nd deadline, while the Swiss franc remains strong despite the recent rate cut from the Swiss National Bank, which does nothing to weaken the currency, alas when the global risks loom. The dollar franc, as such, has been unable to break above the 0.8850 level, even with a broadly stronger US dollar yesterday. And speaking of the US dollar, the dollar rallied at yesterday's trading session against most majors, but is under a decent selling pressure this morning in Asia. The tariff talks' impact on the US dollar has been surprisingly negative so far, but the dollar's direction from here will likely depend on how the countries will respond to the US tariffs. So if there is no retaliation, the US dollar could eventually rebound on relief that the impact of the tariffs on American exports, hands on the American growth numbers, would be more contained than otherwise, while retaliation from the US biggest trading partners would further hammer the US growth prospects and weigh on the US dollar. This is how the thinking goes. And as per retaliation, well, it's a big unknown really. And the Chinese clearly said that they would retaliate, but the Europeans are not so sure. Because on one hand, they do have this urge to respond to the aggressive trade policies from the White House to show that they won't let the US do whatever it wants to do without any consequences. But on the other hand, the Europeans are still a bit worried that imposing tariffs on their own to US imports would have a more negative impact on the European economies than otherwise, that they have more to lose to respond than to keep cool, which is not easy to do, but maybe sometimes you have to do it. So this is where we stand right now. The only certainty is uncertainty. It is difficult to foresee the next direction in the market, whether it's for the US dollar or equities. The pricing and the market moves will heavily depend on political decisions that tend to be very, very hectic and unpredictable since the beginning of this year. So in this sense, we think that the correction in the markets is the most likely scenario. Therefore, gold is the only place that looks safe at this point. It is boring, I know, but it is what it is. For those who are still interested in data, the US will be revealing its latest GDP update today, and the US economy is expected to have slowed from above 3% to 2.3% in the fourth quarter of last year, and the price pressures are expected to have increased, and that even before Donald Trump and his policies came to the White House and started invading the headlines. So the combination of low growth and high inflation is obviously bad for the market mood, bad for both equities and the US dollar, but the geopolitical headlines these days are obviously more influent enough to temper the potential impact of any economic data on the market moves and on the global market sentiment. Voila. And before we go, the UK's budget day went as smoothly as it potentially could go, really, when you think that Rachel Reeves announced £14 billion welfare cuts while increasing the military budget by an additional £2.2 billion into 2027. The OBR, on the other hand, held its 2025 growth forecast from 2 to 1%, but at the end of the day, investors looked more reassured than otherwise that the finances will be kept in check in the United Kingdom. So the 10-year gilt yield first peaked but fell after the budget announcement, and cable fell below the 1.29 psychological mark yesterday, also impacted by a set of softer than expected inflation numbers, but rebounded to trade above this level again this morning. But I think it's actually more interesting to observe the euro pound to see how sentiment in sterling really changed yesterday after the UK's latest budget announcement and the inflation numbers, as there's just too much happening with the US dollar right now. And the good news here is that sterling could actually erase its early losses against the euro yesterday after the data and the budget, and is even stronger this morning, with the euro pound testing the 100-day moving average to the downside. That, to me, is a sign that the budget day went quite well. Rachel Reeves avoided a potential market turmoil, but whether the no-incident budget day could give a sustainable support to sterling is yet to be seen. Because with spending and growth prospects for the UK looking much weaker, well, all eyes and all hopes are on the Bank of England right now. Happily, yesterday's CPI numbers were softer than expected. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, and on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.